So friends, let's get started. Today we are going to cover the chapter 2, that is Introduction to Securities Market. What is securities? Securities are basically financial instruments issued to raise funds. Let's say your friend is in need of some funds to start a company, and you, being a very good friend, give him some money, and they use this money to generate profit, and they are also happy to share a part of the profit with you. Looks like a good deal, right? So same is what a financial instrument or securities basically try to achieve. The primary function of a security market is to enable the flow of capital from those that have it to those who are in need of it. It's not basically like you donating money, but it is basically also you trying to get something out of it. So what does security market do? It's there to help in transfer of resources from those who are in idle or surplus to those who are in productive need of them. So you having some money in your bank account which is just lying idle, you give it to a company, and the company generates some profit out of it, and you get a part of the profit, and that is what securities is. So broadly stating, a financial market can consist of all these different type of participants. Investors like me and you, which are also called as retail investors, and also there are many of us who are also investing in mutual funds. Second is called as borrowers or seekers of fund. They can be banks or companies. Third is intermediaries. They can be stockbrokers, merchant banks, investment banks. Don't get worried if you don't know these words, because I will be covering each one of them in detail in the subsequent slides. Because the main idea of this entire chapter 2 is to understand what each term means. We are going to learn about what are the different type of transaction, what are different type of intermediaries that are available in the security market. So we are not going to learn any new concept here. We are just going to make sure that you know all these people who are actually participants of the market, you know all the transactions. So stay with me till the end, and we'll take it very slow and easy for you to understand. Next is regulatory bodies. They can be RBI, SEBI, or AMFI. RBI, as you know, Reserve Bank of India. SEBI is Security Exchange Board of India. And AMFI is Association of Mutual Funds of India. Here's a small diagram which helps you understand how the flow of funds happen. Say on the left side you see there is a surplus income units, and on the right side you have deficit income units. It basically can happen in two ways. One is called as direct financing. You basically directly giving this fund to people in need, or second could be indirect financing. And most of our chapter today is all about this indirect financing, that is you as an investor investing in some mutual funds, or let's say buying the shares, and all these are all going to happen through financial intermediaries where your fund will be transferred to them, and once you are selling these you say shares, you will basically get the funds back also along with some profit or loss. So talking about it, it's very important that you understand what securities is. Below is the definition of securities as it's given in the Securities Contract Regulation Act. This definition is not something that you have to mug up. It's just something that you should understand. One is called shares or scripts can be called securities, derivatives can be called securities, units of mutual funds can be called securities, and even government securities are falling under the definition of securities. Why this slide has been put here is so that if somebody asks you where is the definition of securities given, you should be able to tell that it is given in the SCRA Act, that is Securities Contract Regulations Act. Okay. Next, let us understand what is equity shares. Equity shares basically represent ownership in a company. Say for example, if your friend is having this company and the net value of this company is, let's say, 1000 rupees, and he has splitted this into 100 shares. So each of this share has a value of 10 rupees. Okay, so this is what shares is all about. If a company wants to divide its complete asset into, let's say, it can be in lakhs and all. I have just given you an example where this person has just divided 1000 rupees into 100 parts, and each of them have 10 rupees value. So you basically giving this 10 rupees to the person and holding this one share is makes you a shareholder of that company, and which can also mean that you are partly also owning that company, though it's your friend's company, but you are also, let's say, if you just buy one share, you are 1% owner of that company, which makes you entitled enough to get the share of the profit. How do you get the share of a profit? By the form of dividends, What does dividends mean? Dividends basically mean that this money that the company is making, if it cannot reinvest it into further development, they might just as well give away to all the investors or shareholders. That is what dividends is all about. Second is in the form of capital gains. Let's say if this company is making profit from 1000, it's went up to 1200. So what would be the jump that you will see? Instead of the 10 rupee share, the value of the share has now risen to 12 rupees. So this 2 rupees is your capital gains. At the same time, you also bear the risk, because let's say this 1000 goes to 800 rupees. That basically means your share value has come to 8 rupees per share, and that would basically make you also bearer of the risk of the business. So that the company, if it makes profit, you are getting profited. If the company is making loss, you will be at loss also. These are basically issued by companies and they are regulated by SEBI and Companies Act. Okay, next let's understand what is debentures, bonds or notes. You must have already heard your parents maybe saying that I hold so and so bond. So what is bond? Bond is basically a debt instrument. These are instruments used by companies or governments to raise long-term loans. They may be secured or unsecured. So what does long-term loan mean? So whenever you are investing in a bond, you are basically giving out loan, just like bank gives loan to us, you are basically giving out loan to any infrastructure project or any company or any government. There is also issues of bonds for NHAI, that is National Highway Authority of India. So what you are doing is you are putting in some money for next 5 years or 10 years and getting around 6 to 7% of interest rates on that bond. Only the flip side is that you don't basically get to take this money after say 6 months or 5 months. Okay, so that is what the bond has a issue, that you cannot basically take this money in very short term. It's a long term investment that you are doing. Okay, it comes as secured and unsecured. What does secured and unsecured means? When you're taking a loan, it's called secured if you have some very good collateral. Say for example, if I take a loan and I say if I am not able to repay that money, I have my house which you can take, so that makes it secured. Second way would be something called as unsecured. That basically means that I don't have anything to put as a collateral, and that makes it unsecured and slightly risky to invest in. Next is what is called as convertible and non-convertible. There are some bonds which can be later converted into equities after say 5 years or 10 years. There are also bonds like that which cannot be converted at all, which is called as non-convertible bonds. We'll study in details about these bonds in the coming videos. They are offered as fixed interest and are regulated by SEBI and RBI. Next, let's understand what is short-term debt instruments means. Short-term debt instruments are used to borrow money for less than 1 year. Say the above example is about investing money for more than, let's say, 5 years or 10 years. This one is an example of borrowing or let's say giving out money for less than 1 year. For example, if you are giving out this loan to government, it is called as treasury bill. If you are giving loan to companies, it's called commercial paper. If you are giving loan to bank, it is called a certificate of deposit. They are usually having a very low risk and it gives you a fixed short-term return. So if you have money lying in your bank and you want to get a better return, you can invest in these short-term debt instruments and you can keep a short horizon of less than a year and still get a better profit than the saving bank account. Now let's understand what is warrants. Warrants are not at all common in India. It works very similar to how the futures work. It is basically giving you right to buy a share at a fixed price in the future. They are usually issued by the companies and also are traded in the stock exchanges. So basically what happens is you get to basically buy a share at a future date for a fixed price. Let's say 100 rupees is the current value of the stock. You have basically been given a right to buy the same stock for 120 rupees, but maybe let's say 2 months from now. Okay, that is how the warrants basically work, but not very important for you to understand. You should know such a thing exists. That's it. Next is market indices. What is market indices? Market indices basically indicate the market trend, and the most common ones are Nifty and Sensex. A lot of us must have heard people saying that the Nifty has fallen, right? So what is Nifty? Is Nifty a company? No, Nifty is basically just index. What does this index capture? Index is capturing the prices of all the top 50 companies as per market capitalization in India. Okay, So if the majority of the companies are seeing a downfall in their share value, you will see that Nifty's value is also coming down. If majority of the companies are getting profit, you will see the Nifty's value will also see that profit. So it is a good indicator to know how the market is doing. If you see the Nifty is doing well, usually will see that most of the companies are also going to give you very good returns at that time. If the Nifty is down, you will usually see that even the other 50 companies which are next to it will also see a small loss, because it is a clear indicator that the sentiments of the market is not very high. Okay. Next is mutual fund units. What is mutual fund units? Mutual funds are the units which basically pool the money from the investors and invest in stocks and bonds. They issue units to investors, and value of each unit, that is NAV, changes daily. Okay. So mutual funds units, you can basically compare them to Nifty only. When you are talking about Nifty and the value of the Nifty, it is basically giving an indication of all the share price of that 50 companies, right? Similar to that, a mutual fund unit or NAV is basically an indicator of the share price value of all the stocks in which this mutual fund has invested. So in mutual funds, what is happening is that you being a shareholder is not directly investing any stocks. You are basically dependent on a mutual fund manager who will invest on these stocks on your behalf. And this person, being a mutual fund manager, knows which are the good funds to invest in, and he will put in your money there, and he will get you slightly better returns than the market. At least that is what he's supposed to do. Okay, so here are few terms that you should understand. One is NAV. NAV is called as net asset value. Say for example, if you have invested in any mutual fund for say 100 rupees per NAV value, and later on you get an exit at 120 rupees, this 20 rupees is what your profit is. Okay, and that's how you will basically end up calculating the total profit. Next, you have to understand in mutual funds you have various types. There's a detailed video series that we are running on NISM 5A, that is mutual fund distributor. If you are somebody who is also interested in this exam, we have got you covered. We have got the chapter explanation videos, and we have also got the question and answer video series in our channel, which you can definitely check out. Okay. At the same time, you have to understand there can be two types of funds. One is called as open-ended and close-ended funds. What is open-ended funds? Open-ended funds basically mean they do not have an expiry date. So if I have a mutual fund which is running for last 25 years, until the time this fund is active, there is no expiry to it. I can keep on investing if I want, or if I want to hold that money there, I can keep on holding that fund indefinitely. Next, you have to understand is called as close-ended fund. What is close-ended fund? They usually come with a fixed duration. It can be 5 years, 10 years. So basically, once it's 10 years are over, you are basically supposed to take the money out of those funds. Next is exchange traded funds. Exchange traded funds are also called work the very similar way as the mutual funds work. They are basically tracking an index or a commodity. Just like you are trading the shares on the stock exchanges, they are basically similar to that, you can say. Only difference is that in mutual funds also you have something called as active and passive funds. What is active funds? Active funds basically means they have got these fund managers who are looking at opportunities how to grow your money faster. And since they are actively managed funds, they are usually having expense ratios which are high. That basically means the commission that this mutual fund manager will take will be slightly high as compared to passive fund managers. What is passive fund management means? Passive fund managers will do nothing. They will basically just have the replica of the Nifty. Say Nifty is in having these 50 companies, they will also have the same 50 companies, and they will put in their money in the same ratio as they have at the market capitalization shared in Nifty, and they will get almost same amount of profit as the Nifty would give, right? So these type of funds are called as exchange traded funds. They are mutual fund units that track the index or commodity and trade like shares on stock exchanges. They combine the diversification of mutual fund with real-time trading. Since ETFs is passively managed portfolio, its expense ratio is typically lower than that of the mutual fund scheme. Now let us understand what is preference share. Preference share is often a very common phrase. You have heard that there is a preference share being distributed. Preference shares are not same as equity shares. These are special shares that offer fixed dividends and get priority over common equity at the time of dividend payments and liquidation. They don't have voting rights but combine the features of both equity and debt. So here you have to understand, friends, say when you are taking a share, you are also becoming a part owner of the company, which basically gives you voting rights. Say if you have significant amount of shares in a company, you are able to also decide a lot of things about where the company should invest more money and so and so. But preference shares doesn't give you any voting rights. So it's basically you are not owner of the company, it is basically you giving out debt to the company because they are in need of money. So when a preference share is issued by a company, you are entitled to get a fixed dividend. And also, say for example, for any reason if the company is paying any dividend, you are the first person to get the dividend even before the shareholder. Let's say this company is going bankrupt and it has to liquidate, even before they pay the money to the shareholders, you are entitled to receive your money. Okay, that is what the preference share is all about. Next, let's understand what is convertible debentures. Convertible debentures are bonds that can be converted into equity shares at a future date. They offer fixed interest income initially and a chance of capital gains after conversion, making them a hybrid or debt and equity. So what does that mean? Basically, it's a debt instrument. You are basically giving out your money and hoping that you will get a fixed interest rate every month or every year, let's say. But it comes with a future date. Say that after 5 years you have this ability that whatever the amount has got accumulated, you can basically convert it into equity and then you become an equity holder. That is what a convertible debenture means. They come in three forms. One is called as partly convertible debenture, second is called as fully convertible debenture, and third is called as optionally convertible debenture. Fully convertible basically means that you are able to convert the entire sum that you have as the debt units into equity. Partially basically means you cannot basically convert the entire amount but only a part of the amount into equity. And optionally convertible debenture basically means you have been given an option whether you want to convert or not. If you choose to keep it as debt, that is also fine. Next, let's understand what is depository receipts or DRs. They represent the share of a company traded in another country. ADRs are for US, GDRs are for the global markets, and IDRs are for India. They help the companies raise capital globally and allow the investors to invest across borders. Say for example, there is a person sitting in US or in Germany and he wants to invest in India. So what he can do is they can use IDR, that is called as Indian Depository Receipts. That basically means these are issued in India, and if somebody wants to invest in a market of India, they can basically buy out these IDRs and the fund will be taken by the companies. So this is what the whole concept of depository receipt means. If the company is issued in USA, it's called as ADR, that is American Depository Receipts. Next, let's understand what is foreign currency convertible bonds. So FCCBs are bonds which are issued in foreign currency by Indian companies. They pay interest and can be converted into equity later. While investors earn in foreign currency, the dividends or conversions is paid in rupees. So for example, if you are a foreign investor who wants to invest in Indian companies, but at the same time you don't like to convert your money to rupees to invest, this is a very good option, because what will happen is, like, you have dollars or euros, then you can basically invest in the same currency in the Indian companies using the FCCB, and at the same time, once you are done with your debt fund, if you want to convert it into equities, even that is allowed. But only catch is that once the dividends are given out by the Indian companies, they will be in rupees, which might have to be then converted into a foreign currency. Okay, but at the same time, whenever it comes to interest rate or keeping things in bond itself, you will basically get the interest rate or as the currency. That basically means if you are invested in dollar, you are basically getting also returns or interest rate in dollars only. So you don't basically incur this currency exchange rates. Next is called as equity linked debenture. What are equity linked debenture? They are bonds which return depends on the stock market performance, which is very contrary, right? Actually, when we say debt instruments, we say that they are not dependent on the stock market performance. But this is a different type of debenture, which is basically equity linked. In this case, what is going to happen is that a part of your investment will be used for capital protection, and then rest is basically invested into equities. So it is making sure that the money that you have invested remains secured, and the rest of the money, whichever is there, they will put in to make sure that you also get some exposure to the market, so that you get a better return than the normal debt instruments. Similar to that is called as commodity linked debentures. What is commodity linked debentures? Basically, they are the ones which are investing in golds or silver, just like you talked about equities, right? They can also be investing in golds and silver. They also work with the same principle that, they put as part of the money for capital protection, and rest of it they will put it into the commodity market, so that you get a higher potential returns. Next, let's understand what is mortgage and asset-based securities. These are bonds backed by cash flows from loans like home loans or credit card dues. They help the lenders to illiquid the asset into tradable securities, offering liquidity and investment opportunities. After having understood this, let us now go to sector of the securities market. A security market can have two types of participants. One is called primary market and second is called a secondary market. What is primary market? Primary market is what you have usually commonly heard as IPO. It's also called as new issue market, in which the issuer raise a capital by issuing the securities to the investor. Fresh securities are issued in this market, which basically means that, say you what would be primary market is when a company is issuing fresh shares initially to all the public. It is called as primary market, because who are the people who are involved? One is the company and second is the investor, so that makes it primary market. In secondary market, the investor has already bought the shares from the company, and this share is being sold to another investor. So these type of transactions where the companies are not involved is called as secondary market. Why? Because this is where the investor buy or sell the securities after they are issued. It provides liquidity, allowing investors to exit or enter investment. Trades happen without the involvement of issuing company. That is the important factor. So where the company is involved, whether it's about issuing the fresh shares, it's called primary market. Where the company is not involved, it's only the investors who have initially invested trying to basically sell or buy new shares, is what secondary market is all about. Let's now understand the primary market completely. One is thing that you have to understand is what is public issue. Public issue is when a company is selling its securities to general public. Anybody is eligible to invest. It helps the companies basically to raise the funds from a wide range of investor, mainly retail participants. Okay, so when the company is issuing this issue, they are not really dependent on single investor, because if there is a single investor, they can maybe decide to go off. But when it comes to retail investment, there are so many people that cannot be basically brainwashed, and there's even security for a company when they are issuing something as a public issue. So it's company who is trying to raise the funds from a wide range of investors, basically retail participants like you and me. In the public issue, there are two types. One is called as initial public offering. An initial public offering is a company first sale of shares to the public. It helps to raise the capital for expansion and makes the company publicly traded. SEBI sets the rules for eligibility, disclosure, and listing of IPOs. You have to understand that when a company is bringing an IPO, it is not an independent activity by the company. There are a lot of rules and regulations set out by SEBI to make sure that this whole thing happens in a proper way. There are eligibility conditions set, there are proper disclosures that this company has to make, they have to do listing in the IPO. So it's a long process. There are many participants which are involved in this IPO. And then once the company is giving out the IPO for the first time in the market, it is called as initial public offering, where let's say it decides that it wants to sell out, say 50 crores of the company asset into shares, and they will basically sell it out to all the people. They will decide what the price would be, and people can basically bid for these shares, and 1 to 3 days later they will come to know if they have got an allotment for the shares or not. That is what initial public offering is. Next is follow on public offer. Follow on public offer is when listed company issues more shares, allowing the existing shareholders to sell theirs. It helps to raise additional funds or meet regulatory requirements like increasing public shareholding. So what does follow up public offer means? Let's say I am a venture capital who invested at the time of IPO, and I invested, let's say 20% of the company belongs to me. Now the company has expanded and I have got how much profit I wanted, and I feel that now I should take the money back and maybe invest in somewhere else where the money can grow faster. So what I would do is I will ask the company to do a follow on public offer. So in that case, I will basically be able to liquidate the amount that I have invested, and I will get and book my profit, and which will allow the other shareholders, basically the people who want to buy more shares, can basically buy the shares and they can increase their stake in the company. That is what is follow on public offer means. So it's not the first time when the company is going public, it's when one of the major participant or major shareholder is basically liquidating his assets so as to book the profit, is what the follow up on public offer means. Next, you have to understand what is private placement. Private placement is shares offered to a small group of select investors, not public. It's faster, it involves fewer regulation, and examples include qualified institutional professionals and preferential allotment. So basically the first to do example is an example of public issue where the company is basically trying to raise the funds from public, but at the same time they can also do private placements, right? They can go to qualified institutional placements like say some banks or some mutual funds, and they can get the money from there. They will get money in bulk in that case, right? But at the same time, SEBI has also set rules on how much money can be raised from these qualified institutional placements. They cannot raise the complete money from them, even though the QIP might be ready. SEBI has set very big rules to make sure that this market is fair and transparent to the retail investors also, that retail investors also can make use of this opportunity to create wealth. Next is preferential issue. A preferential issue is when a share is issued to a select group of people on a private basis. It's not open to public, follows strict SEBI and Companies Act disclosures and lock-in period. So preferential issue is, say for example, for a selected number of people. For example, if Air India or say any other company is going public, what they would do is that if you are an employee of the company, you can basically get the share for a slightly less value. That would be an example of preferential issue. For a certain group of people, you are entitled to get this share for a slightly less value, but at the same time it comes with strict SEBI rules and Company Act on pricing and disclosures and lock-in periods. Okay. Next is rights and bonus issue. What is rights? Rights and bonus are two different things. Rights issue lets existing shareholders to buy more shares at a discount. So that basically means if I am a shareholder of Infosys, I am basically being given an offer. Okay, friend, if you want to invest or buy more shares from us, we will give you a discount. You can take, let's say, 10 rupees or 20 rupees cheaper than what is available in the market. And I, as a shareholder, I am happy. And as a company, you are happy because I have been a long-term investor in the company. So that is what rights issue is all about. Next is bonus issue. Bonus issue is basically when the company is making profit, and if it wants to, let's say, split the shares, it can do that by issuing the bonus. Splitting is two different things. Okay, if say you have a share of 50 rupees and if you split into two, then each of your share is of having a value of 25 rupees. Splitting is different. Bonus is different. What is bonus basically mean? Bonus are ratios. It is coming as 1:2. What is 1:2 basically means? If you are holding 2 shares of the company, you will be given 1 share. Okay, it can come in different ratio. It can even come to 2:3 ratio also. That basically means if you are holding 3 shares of the company, you will be getting 2 additional issues of the shares. Okay, so bonus issues are totally free of cost. Rights, where else it's optional. You can basically buy the shares at cheaper cost, but else bonus, since it's like gift which is given away, they are automatic and they are completely free. Okay, next let's understand what is onshore and offshore offering. When a company wants to raise money in India, it is called as onshore offering. When it wants to raise funds from abroad, then it is called as offshore offering. So companies may choose, depending upon their goal, where to raise the money. They can raise it from India. They might raise, if they think that they need some foreign investments, they can do that. So only term you have to understand is onshore basically means it's the money from India, and offshore basically means it's the money coming from outside. Now let's understand what is offer for sale. Offer for sale is when existing shareholders sell their shares to public. The companies doesn't go get any money, the seller does. Government disinvestments through PSUs is a common example of offer for sale. Offer for sale is like, say, there are many of the entities from where the government has taken its stake out, right? So government doesn't want to come into a place where they are investing as a shareholder, but they want to play a role of a regulator in the market, which is very good thing. Okay, but at the same time, when they are selling their existing stake to the public, that is called as offer for sale. And when these type of sales happen, the companies don't make any profit. It is basically just the percentage whatever they were having in the company that gets exchanged to the public. Okay, so company is not making any profit. It's basically government disinvesting whatever share they were having, and it is given out to the public for the same price. Okay, next is secondary markets. What is secondary markets? Primary market, you have understood. Primary market is the playground for investor and the company, whereas secondary market is the playground for two investors. Okay, when two investors are there, there can be different ways how the exchange of money can take place, right? So first is over the counter market. Over the counter markets are private deals between the buyer and the seller, and are done outside of the formal exchange. Terms are negotiated directly, and settlement is managed by the parties involved. Over the counter case basically means, if you have a friend called Manoj and you want to sell your shares to him, you decide whatever price you want to set and you take the money from him. Okay, that is over the counter. It is basically happening over a talk or a negotiation. Usually it doesn't happen between two friends. It happens between two HNIs maybe, and they decide on what terms they are doing it, and they basically do the settlement of the securities and the fund that is involved. So the entire thing happens outside of the exchanges. That's why it is called as over the counter market. Next is the opposite, that is called as exchange traded market. That is where we do it. That basically means trading is happening through stock exchanges like NSE and BSE. Settlement is guaranteed through clearing corporation, which acts as a middleman, ensuring both sides get what they are due. So you have to understand here, whenever you are investing through any platform like say Zerodha, Angel Broking and all of these exchanges are happening through either NSE or BSE. Settlement is something that we are going to understand in the next slide. Settlement basically means that the shares that you have bought you will get, and the money that you have put in, the party which is selling will get. Okay, so this whole thing is also guaranteed by the clearing corporations, and which is basically acting like a middleman, making sure that everything is fair and transparent. This is the exact thing which is missing in the over the counter market. If say one of the parties says that, okay, I have given you the shares, but I don't or I have given you the shares and I have never received the money, and nothing can be done about it because there is no legal obligation, right? Whereas when things are happening through the trade exchanges, it is making sure that you are basically getting the money for the shares you have sold. What is trading? Trading is an act of buying or selling securities. In India, most trades happens electronically through the stock exchanges using systems that match the buyers and sellers instantly and efficiently. So this is one thing you have to understand, that the logic behind the softwares also. Let's say you are placing an order for 50 shares to be bought, then the system itself matches the same order for the same time with other people who are basically ready to sell, and that is how the matching happens, and it works almost instantly, and it's efficient way of clubbing an investor or to a seller, and there is no identity also revealed, that you don't know when you're selling a share in the market who is basically buying it. It could be anybody from almost lakhs of people, right? So that's the beauty of the trading with the automation which has come in. Next is clearing and settlement. So after trading has been done, so you have placed an order that you want to buy say 50 shares for so and so amount. Okay, so what is happening behind the scene is what we are going to cover. One is called as clearing, another is called as settlement. Clearing basically identifies how much each party owes. And settlement means delivering the shares and paying the money. For exchange trades, this is done by the clearing houses to ensure smooth and secure transaction. So what you as a buyer wants is shares, right? And for that you have given some money. So this money should reach the person who is selling, right? So this whole thing is basically taken care by the clearing houses. So identifying who owes how much to the other party is done by as part of clearing, and settlement basically means that you receiving your shares and them getting their money. Okay, that entire thing is basically taken care by clearing houses. Okay, I'm telling clearing houses because later on we will go through which are the intermediaries in the market, and you will come to learn about a term called as clearing corporation. They are the ones who are doing all of this behind us. Okay. Next is risk management. You have to understand that like I mentioned, over the counter trades are basically having a lot of risk, because the parties who are participating in it can basically say that, we don't want to give you the money, or, they take the shares and they don't give the money. All this can happen. But when it comes to exchange traded market, the clearing corporation is managing all the risk. It is saying that there is no default going to happen. I will make sure that if your share is in something, you will get the money for it. So they do a lot of calculations based on initial margin, mark to market margin, and all, which I have detailed covered in the depository operation course that I run. We have got NISM Series 6 along with their mock test covered in mocktestchannel.com. And if you have not seen Research Analyst mock test, please go through the Research Analyst mock test, because building concept is important, but at the same time knowing which questions are commonly being asked currently is very important to pass this exam. So do check out the website on mocktestchannel.com, where you will find the Research Analyst mock test questions. So what is risk management here is that the basically are all the intermediaries which are involved in making sure that as a person, as an investor, you don't face big loss. Because as you might have heard, in the share market there is upper circuit and lower circuit. It can happen that the shares are fluctuating at such a violent rate that you can end up losing a lot of money, and that's where the share market is coming in role. These intermediaries are coming in role to make sure, okay, if there is a certain say amount after which if the share is fluctuating, then it will basically cut off the trading for that particular stock. It is done only to protect your rights, friends. Okay, that's how exchange is basically also participating in risk management. So now let us come to market intermediaries. Who are all the market intermediaries who are doing this whole game? One is called a stock exchange. Stock exchange is like NSE and BSE. They provide you platform for buying and selling the existing securities. Trading is done electronically with anonymous order matching, like I mentioned before. And they also manage the clearing and settlement of trades. So these are stock exchanges. One is called National Stock Exchange and another is called as Bombay Stock Exchange. Next is depositories. Depositories are like NSDL and CDSL. They hold the securities in digital form. They help the investors to store and manage their shares securely. Transactions through are done basically through the depository participants. So I don't know if you have a Demat account. Of course you must be having. So these Demat accounts are basically opened through NSDL or CSDL, because they are the main depositories that we have in our country. So what is the main function? Let's say you bought a share. Where are you going to keep the share? Do you have it in paper format? No, you have it in the digital format. So this digital demat or the digital share is basically kept as a security in the digital form with these depositories called as NSDL or CSDL. Okay. And how you do it? You do it through depository participant. Who are depository participant? Depository participants acts as agents for the depositories, and they deal directly with the investors. They open Demat account for you. They help in buying and selling the shares in electronic form. Banks, brokers, and financial firms can be depository participants. We also, like I mentioned, have NISM Series 6, which is a detailed course on depository participants, which is very interesting for people who want to get to know a lot about how the depositories function, or you want to get a job in the depositories. This is a really important course, NISM Series 6. Many of our students are clearing this exam with flying marks, I would say. Let's go to the next thing, what is called as trading members and stock brokers. So stockbrokers, you already are well aware, there's angel brokers, there's Zerodha and all. So all of these people are stockbrokers. Stockbrokers are registered members of stock exchanges who place buy and sell orders for clients. They must be SEBI approved and meet infrastructure and capital requirement. Brokers earn commission for their services. So all these people who are giving you such a nice platform to trade on, they are basically doing it because they get a commission out of it, right? So at the same time, SEBI has made sure that they should have a required infrastructure, they should have enough capital requirement. They have been given that in order to run a company as a stockbroker, you should have at least this much fund kept, which is so as to cover the risk, and only those people who are having that kind of amount are only allowed to be stockbrokers. Okay. Next is sub-brokers. Sub-brokers are not exchange members, but they work under the main brokers to serve the investors, because these stock exchanges cannot reach to every small town and villages, right? So they depend on these sub-brokers who would basically go and they would go and ask the investors to invest, and their orders are basically passed to the brokers who would finally execute them. Okay. Similar is the role of authorized person. An authorized person is an agent who is appointed by a broker to take more investors. They must be approved by the stock exchanges, and they extend the broker services to wider locations. So there can be authorized persons who might go and ask the investors to invest in in these stocks basically. Okay. Now let's understand what is custodian. Custodian is a very common word. We used to have a housing society where one of the person is held a role of custodian, and what he used to do is he would be the one who would keep all the money that comes from all the residents in the apartment. So same is the role of custodian in the financial also. In the financial institution, a custodian holds and safeguards the assets like securities, cash and other valuables on behalf of the individual or corporation or institutions. They are responsible for safekeeping, administering and reporting of these assets and ensuring the security and proper management. That's the role of custodian. They basically don't take this money. They are basically are there to make sure that all of these things are managed well. They are, basically you can call them safeguards of all these things. Okay, next is clearing corporation. Like I mentioned to you, clearing corporations ensures that trades are completed smoothly. They guarantee the payment and delivery of every trade. They act as a legal counterparty to both buyer and seller. So for example, you have basically traded as a buyer and you are supposed to get your shares, and say you did not receive it. How will you catch the seller? You don't even know who the seller is, right? But that's where the clearing corporation comes as a guarantor. He says that, okay, you have bought the shares, doesn't matter if the seller is not giving, I will give the shares to you. So he's being that guarantor of making sure that everything is smooth in this operation. And you basically, of course, don't know who the seller is, right? But all through this process, clearing corporation takes care of all the legal formalities and making sure that you get your shares on time. Next is clearing banks. Clearing banks are used by the clearing members to transfer the money for trades. Funds must be available on the settlement day. These bank credit or debit funds after trades are finalized. Okay, so clearing banks are basically working with the clearing members, and their main role is to make sure that if somebody has sold their shares, they should get the money back, right? So this settlement of this money task is taken care by the clearing banks. Okay, next let's come to merchant bankers. What is merchant banker? Merchant bankers help the companies to raise capital from the market. They manage the IPO, fix pricing and coordinate with the other agents. They are SEBI registered and act as issue managers. So merchant bankers are most important when it comes to IPO. If you are a company and you want to start an IPO, first thing that you do is you tie up with a merchant banker, and this person knows how to do the IPO well, and he knows how or what price the each of these stocks should be sold. He will coordinate with all the agent and he will make your process completely smooth. For that, he has to be registered with the SEBI, and he should act as issue manager for an IPO. Next is underwriter. Say for example, you have a company and you want to go public and you want to sell it to your shares to the public, and let's say you have 1000 shares to sell, only 500 people subscribe to the IPO, and you ended up selling these shares to 500 people. What about the rest of the 500 shares? Where will it go? That is where underwriters come in role. Underwriters agree to buy the shares not picked by the public during an IPO. They ensure that the issue is fully subscribed. Hard underwriting gives full commitment and soft underwriting is conditional. So underwriting can be of two types. One is called as full commitment. That basically means like doesn't matter, even if one of the share is not getting sold, I will take that complete 1,000. That is like full commitment. Soft underwriting could be like, okay, I am ready to take up to 50% or 30% of the shares. At least you 70% you should be able to sell by yourself. Okay, that's called soft underwriting. Next is institutional participants. Who are the institutional participants? One is foreign portfolio investor. You must have heard it. There are many people who are currently living overseas, or they might be foreigners who want to register with SEBI and they want to invest in Indian market. They invest in stocks, bonds, and other financial assets. They basically are very important to us because they bring this foreign capital. We want dollars and euros to flow into India. So that is what these foreign portfolio investors do. They basically are coming and registering with SEBI, and they are then basically eligible to invest in the Indian markets, and we basically also get benefit out of them because they are investing in their currency. So other than that, there is something called as P-note participants also. P-note participants are usually not registered with SEBI, but they are registered with these foreign portfolio investors. So these are foreign investors who want to India, basically invest in Indian market, but at the same time they don't want to go and register with SEBI and all. These investors can basically invest through these foreign portfolio investors. And what will happen, that whoever are investing through them, they will be called as P-note participants. The P-note simply is a foreign investment in Indian securities. Okay. Next is mutual funds. Mutual funds I have already covered in this video. Mutual fund, what it does, it's basically pools the money from many investors to buy a range of securities. There are fund managers who do that. All the investment decisions are taken by them on behalf of the investors, and their main duty is to spread the risk, and they basically are doing a very good job in simplifying the investing for individuals. If you are an individual who doesn't know much about stocks, you can invest in mutual funds, and they will make sure that your money will get compounded on a yearly basis if you are going for a long horizon investment. Next is insurance companies. Insurance companies collect large funds from the policyholders and invest in markets. They are major investors in shares and bonds. Their investments support the economy and ensure returns for the policyholders. So insurance companies, like you already know, LIC is there, you have Max Life Insurance and Axis now, which is called. So all of these are insurance companies. What they are basically doing is they will collect the premium from all the policyholders. They will use this premium, they will invest in shares and bonds, and make sure that if any one of them has some problem, say somebody dies, then they will take this money and they will give it to the needy person. Okay, it can be of many forms, motor vehicle insurance, life insurance. All of this basically are coming from the same concept from the insurance company. Okay, they are basically pulling in the money from all the people who carry a risk, and they give this money to the people who actually suffered because of that risk. Now let's understand what is pension fund. Pension fund invests in retirement saving for long term. They provide income after retirement. These funds are managed by financial institutions and larger corporations. There's a lot of pension funds out there. So if you are young, you basically end up investing a certain sum with the pension funds, and once you are retired, you are basically expected to get this pension from the entities. Ideally, because a lot of time before there used to be government jobs and many people would get their pensions, but now since most of us are in the private side, we are not basically anyway secure to get these funds, right? So that's why it's very important for you to understand this importance of pension funds. Next is venture capital funds. What are venture capitals? Venture capitals are basically people who would invest in small startups and small business with high growth potential. So how will they get the money to invest? They can even ask you for the money, and that's where the venture capital funds come in role. Venture capital funds will collect the money from all these investors who don't know, have much idea, and they will take this money and they will invest into the small business. But usually you should always understand, whenever you are investing in any venture capital fund, it comes with a very high risk. Why? Because these people are investing in small things which might work or which might not work. So there is a lot of high risk involved, but at the same time they usually also offer a big returns because they are also diversifying, because they are not investing in only one company, they are also investing in multiple companies to make sure that at least 4 or 5 of them, if they give profit, they will be able to recover the losses and will also be able to give you profit. Next is private equity firms. What is private equity firms? Private equity funds invest in growing or restructuring companies. They buy stakes in private or public companies and their goal is to improve the performance and sell the profit share. So private equity firms could be, people will see that there are companies which are not performing well, so they will go into that company, they will invest. When the share market price is very low, they will do all the restructuring of the company, and once the market is already back in that company, then they will make an exit and book the profit. That is what private equity firms do. Next is hedge funds. Hedge funds are high risk funds. They invest across markets and strategies. Their aim is to high return and are less regulated. They are use complex techniques that are meant for experienced investors. So hedge funding is something which we commonly use even in futures and options. I will go and explain you that in detail in coming slides. So just wait for it, I would say. But for now, you just should understand that it comes with a lot of risk, and somebody who is completely new should not attempt it. But we'll go through it. Next is alternate investment funds. What is alternate investment fund? Alternate investment funds include the funds which are not included in mutual funds and insurance rules. They can be real estate, SME, startups and more. They are privately pooled and regulated under a special SEBI rule. REIT can be an example of alternate investment fund, wherein you can basically pool in money and give this money to any real estate person, and this person will basically end up building apartment or commercial space, and whatever the profit this person earns, he is distributing it among all of you. So that is an example of alternate investment fund. Investment advisor. What is investment advisor? Investment advisor guides the investor on where to put the money. They assess the goals, risk tolerance and time horizon, and they plan and manage the portfolios for individuals and families. Next is retail investor. What is retail investor? These are people like me and you, individuals, who are basically investing in stocks and mutual funds. They also are doing it not because they want to donate, but they are doing it for their own personal benefit. You basically want to get some good returns when you're investing, right? So some of the retail investors can also be HNI, that is basically high net worth individuals, and it could be NRI, that is non-residential Indians, and they are of particular importance because special rules apply to them somehow, and also because they invest in large amounts. Now let's understand what are the different kinds of transactions. I think here's where you will also understand about hedging. Okay, so let's first start with cash, term and spot trades. What is cash trade means? Cash trade settles on the same day, that is T+0. It's like paying the cash for the groceries. Say for example, you have groceries that you are buying, and you would basically pay the money to the cashier right away, right? So this is an example of cash trade, that is T+0. The same day when you are getting something, you are giving the cash, T+0. Next is term trade. Term trade basically means you are only settling the cash next day. So it's often seen in currency trades. The settlements happen in T+1 round. Third is spot trades. Spot trades happens in 2 days after that, basically means T+2, which is very common in stocks. You basically end up getting the securities in your account only after 2 days, right? So that's an example of spot trades. Next is forward contracts. What is forward contract? A forward is a private agreement to buy or sell an asset at a future date for a fixed price. It is customized between two parties and done outside of the exchanges. These deals carry risk if one party fails to honor the contract. An example of forward contract I'll give you. Let's say you are a farmer, okay, and you have crops to be sold, and let's say you are expecting that the weather will be good and maybe you get around 100 kg per rice, okay. I'm just giving you a random number. Don't ask me why 100 kg, where do you get rice for 100 kg and all. I'm just giving you an example, okay. So 100 rupees per kg is the price, okay. It can also happen there's a bad weather and the price can go up. It can fetch you around 150 rupees per kg, or it can also happen that the weather was super and everybody was able to produce a lot of rice, so the price has gone down and it is only being sold for 80 rupees per kg. So as a farmer, now you are facing this dilemma. You don't know how the weather is going to be, and that's where you will enter into a forward contract. You will find some trader who is ready to buy this rice from you at a fair price, which you think is 100 rupees. And for that, you would enter into an agreement, say forward contract, that okay, friend, when there is a harvest time, you will buy the rice from me at 100 rupees, and you are also as a trader agreeing, because you also feel that there is a risk, because if what if the rainfall and all is there, and you will get this for only 160 rupees, then you don't want to buy it for costly if that is the situation, right? So you also come into an agreement. That is what is forward contract is all about. Forward contract happens outside of the exchange. We also call this over the table over the counter exchange, we are also calling it, because these type of contracts do not have any legal obligation. What if one of the person fails to honor the contract? There is nothing that exchange could do anything about it, because all of this is happening outside of the exchange. So that's why it is called as forward contract. If the same thing is happening inside of the market, then it is not called as forward contract, it is called as future contract. What is future contract? Future contracts are exchange traded forward contracts with a fixed rules. They will have all the things covered, like size, quality and date, and they are settled through the clearing houses, which reduces the counterparty risk. Future access for shares, indices, commodities and currencies. So now you have to understand the situation. Say, as a person who is entering this contract, what this person will do is he will pay a premium amount, okay, for this contract. Say I am a trader and I want to make sure that this farmer is giving me the rice for 100 rupees per kg. For that, maybe I will end up giving him 5 rupees per kg amount in advance. That is called as premium. Okay, that is not the price of the let's say commodity itself. It is basically ensuring that this entire let's say contract is legalized. It's making sure that the person in the other hand has to oblige with it. So is the premium amount that is paying to buy this contract. Okay, let's say 5 rupees. Next, what could happen is that this 100 rupees rice, if say the market is doing pretty good, what will happen is that the rice price would go to 120 rupees, and in that case this trader is at profit. Why? Because since he is able to get from this farmer rice at 100 rupees, he can sell it in the current market price of 120 rupees, and he can gain a profit. At the same time, the farmer is also at profit. Reason being, what if the market was not good and the price was being sold at 80 rupees? He would have lost this 20 rupees, right? So he would basically still be able to sell this for 100 rupees to this person, and he is at a profit at that time, right? Because the current market rate is 80 and he is getting 100 for the rice, because that's how the future contracts work, that the person has to buy whatever he has basically paid the amount for. Okay, so this is how the futures work. At the same time, there is something called as option contract. What is option contract? Option gives you a right to buy, but it's not a duty. Okay, when you say options, it basically means you as a person, you have an option whether you want to buy or whether you can decide not to buy also. So that gives you a trader as an option, that depending upon the market condition, you can decide whether you want to buy it or not. The premium amount whatever you have given is basically given only. You are not able to get it back. Even if you choose not to buy the rice, it's okay. The premium amount is lost. But in the case what is going to happen is that if you are able to get the rice for 80 rupees per kg, you don't end up paying 100 rupees. That is more, right? So as a trader, you are at profit in that way. As a farmer, you are in profit also, because this premium amount which you have collected initially, you don't have to give it back. Okay, so hope you have understood the difference between future contract and option contracts. The future contracts comes with obligation that you have to buy, whereas option contracts say that okay, you can give this premium amount in advance, but there is no obligation that you have to take it. Only the thing is that the premium amount will be lost, but at the same time it's your choice whether you want to buy it or not. Next is swaps. Swaps basically deals with two parties exchanging cash flows like fixed or floating interest. They help the companies to manage the interest rate or currency risk. Only the interested it is exchange, the principle stays the same. So it usually becomes not very common among retail investors. It's between the companies where the swaps happen, where they can basically exchange the interest rates, whether it's a fixed or a floating, and it's basically done to manage their interest rate or currency risk. Next is trading activities. What is different type of trading activities that you are known of? One is called as trading. Trading basically is also referred to as speculations by many, in which you are basically buying or selling an asset to make a quick profit from the price change. Traders usually borrow money to increase their gains, and their activity adds liquidity to the market. So, can you say that people who are investing in stocks are all traders? No. It's the people who are only investing for a short term in order to book profit are called traders. They can be intraday traders who are trying to invest in for like only a day. They could also be people who are investing for a few days or months. They are all called traders only. There can be also people who are investing for 5 minutes to gain the profit. They are super traders. Okay, so basically what they are doing is they are basically buying and selling assets in a very short duration, and they are trying to book the profit. And this activity is not bad because it adds liquidity to the market. Because tomorrow if there is no traders, what is going to happen is that you have so many of these people who are keeping this stocks for a very long time, and when they want to sell it, there is nobody there to buy it only, right? Because of this trading, you are getting a market which is always ready to accept the shares at whatever price you are giving. Okay, hedging. Let's come to the important part. Hedging means taking second position to protect against the loss from first. It limits both the risk and the rewards gain in one, cancel loss in the other. Hedging tools includes options, futures, and swaps. Okay, you remember the story that I told you about the options and futures, right? Say for example, you have went with not options but you went with futures. Okay, futures giving you a right to buy say 1 kg of rice for 100 rupees. Okay, and let's say you get a market condition where the price of the rice is now trading at 80 rupees. That basically means you will end up losing 20 rupees. But what this person will do is he will also buy right to sell the rice for 95 rupees. So that's how the hedging works. Okay, so at one time he's expecting the rice price to go to 130 rupees, wherein he could get a very good profit, that is 30 rupees. But at the same time he can also see that there is a risk that the rice price may fall to 80 rupees and he would end up losing 20 rupees. So he want to risk that cover he want to cover that risk basically, so by also having right to sell something at 95 rupees. So the net loss if he calculates is only of 5 rupees, right? So that is what hedging is all about. Next, let's understand what is arbitrage. Arbitrage is earning from price difference in two markets for the same asset. You buy low in one market and you sell high in another market. These are chances that disappearances as market prices, are adjusting slowly. So you have to understand what is arbitraging. Say for example, you are getting a cabbage for 5 rupees in one market, and in another market you are able to sell it for say 8 rupees. So what will you do? You will take it in bulk in one market and you will sell it off in the other market. Okay, but eventually what is going to happen if you do it on a very continuous basis, especially because it's in electronics, all of that, this difference between the prices will slowly go, because just like you are doing it, many other people will also be doing it, and slowly the difference in the price in both the markets will come to neutral. That is exactly why we don't have these trades which between the countries. If they are all going to have no let's say things involved, it will basically happen that all the markets in the world will have almost similar prices, right? But that's why we have tariffs in place to make sure that that doesn't happen. And also there's income disparity which is resulting into commodities being sold at different prices in different places. Okay, so that's a different topic. But for arbitrage, let's only understand this thing, that whenever there's a difference in the price of a commodity in two different markets, there's people called as arbitrators who would basically take it in from one market and would sell it in another market, and they will book profit. Okay, Next is pledging of shares. You must have heard about pledging something. It is basically giving something as collateral. When I took my education loan, I put my dad's home for, as a collateral. So that is how pledging also works. Which basically means whenever you want to take a loan from the company bank, you don't have to basically put in property. You can also put in a security that you have in account. Of course, it has to be a very big sum. You can hold it, put the securities, and you can tell bank, okay, give me loan against the securities, and when I repay it back, give me my securities back. Or else, if I don't repay my loan, you can sell the securities and recover the bank loan. Okay, it is just like any pledging. You can pledge using gold ornaments also these days. So it depends on you what you want to pledge. So pledging of shares is also something which is possible. Next and the last topic for today is dematerialization and rematerialization. What is dematerialization means? Oftentimes you must have heard that your grandparents must be holding this shares in paper and pen format, okay, and oftentimes they get lost also. Nobody knows. Somebody says, okay, I had invested so much amount in MRF long time back, but I don't know where the papers are. So why? Because they were all in paper format. So the process of converting this paper format into digital format is called as dematerialization. Digital shares are easy to trade and they are easy to store and manage. So today most of the shares are actually issued only in electronic format or demat format, and that's the reason why each one of us has demat account, right? Next, opposite of this process is called as rematerialization. What is rematerialization? Oftentimes you will also see that if you are holding a share in say a format which is in digital form and you want a physical form or a paper and pen format, you can go to the depositories and they will allow you to get a paper and pen format of your digital one. It's very rarely done, but if you are having a fantasy for it, please go ahead. They will issue you a paper and pen certificate, and they will give you the numbers of the shares that you're holding in your demat account in paper and pen format. That entire process is called as rematerialization. Now let us go to the question and answers from this chapter. Like I mentioned, these are just the question and answers which are given in the booklet, but there are more important question and answers which are given in our website. So if you are appearing for the research analyst exam, before we get started on completing this series, please make sure that you completely do all the mock tests that are given in the mocktestchannel.com, especially for research analysts. And if you still have any questions or any questions that is given in the website also, you can reach out to me in the comment section. Also, if you see there are some concepts which are not very clear, you can drop it in my comment section and I will give you a complete explanation to it, and you are able to then grasp it better. Okay, let us now go to the question. First is, as per SCRA, the term securities include which of the following? Options are government securities, B, derivatives, C, shares, scrips and bonds, D, all of the above. So like I mentioned, securities is basically all of the above. Like I showed you the definition of SCRA, securities, this is what is given. Next, along with SEBI and other regulators under Companies Act, RBI also regulates the equity shares market. State whether true or false. Does RBI regulate the equity and share market? No, it's only the SEBI who is doing it, right? So the answer is false. Okay. Now let's go to the next question, where the entire face value of the debenture is converted into equity shares. It is known as. The question itself is giving you answer. Options are fully convertible debentures, B, partly convertible debentures, C, optionally convertible debentures, D, none of the above. And the correct answer is fully convertible debentures. Okay, let's go to the last question. Deposit receipts which are issued in India and listed on the Indian Stock Exchange with foreign stocks underlying shares is known as. So if it is issued in India, it will be called IDRs. His options are given as ADRs, GDRs and FCCBs. If they say that it's issued in America, the answer would be ADR. So that's why it's important that you don't mug up the question and answer and also understand the concepts. Okay, it's very important. So with this, friends, I am finishing this chapter. Hope you found it useful and you can see and feel the voice. It takes a lot of pain to make these videos, and it's even painful if you don't get a very good response after putting in so much effort. So please do hit on the like and put on the channel on subscription list so that you get all these updates, and not for you to get the update but also to keep me motivated, saying that okay, there are people out there who are listening to me, who want to understand these concepts, and that will make me motivated to create more videos. So, and thank you so much for that. And like I mentioned, to give this video a bit of engagement, please hit on, put in something in the comment section, say it was good, it was bad, whatever you feel, please do put some comments, because that will help this video to reach more participants, and I will be able to create more videos and stay motivated to help you out. Okay, thank you so much. See you in the next video.